Number 1. Real estate. In a dynamic economy with high demand but limited supply, we must include assets regarded as hedges against inflation. In reality, these hedges move in the opposite direction of the market since they protect against inflation. According to industry experts, investing in real estate is a sensible alternative in these economic circumstances because property prices continue to rise. Investing in various residential and commercial buildings is one strategy for using real estate as an inflation hedge. Rental properties are another form of real estate inflation hedging. An excellent example would be investors making high profits by purchasing rental homes in an urban region. Past never lies. Looking at how much the property's value has increased in the last 5 years is a good sign that the initial investment is safe and that investors will get rent monthly. If investors decide to sell the property, they will not only get back the money they put into it, but instead they will get more than what they put into it. Number 2. Gold. Do you know that gold price in US dollars is at a current level of $1,827? What distinguishes gold from other investments is that it has always been an asset that has maintained wealth, particularly during times of crisis. When the future seems hard to predict, gold prices go up. Gold prices jumped from around $600 to over $1,000 in 2007 due to the financial crisis. Investors panicked and began buying gold right away. In 2010, speculators panicked again and began buying gold in massive quantities, sending gold prices to a new high of $1,900 per ounce. The economy has since recovered, and the gold bubble has burst. Remember that gold prices tend to fall during predictable, consistent periods. The US dollar may lose value and become worthless, but gold will never be useless. The value of gold has stayed constant since the dawn of civilization. When the United States opened a trade war with China in 2019, gold prices rose again, and the pandemic aggravated the problem. Gold prices crossed $2,000 per ounce for the first time. No wonder gold has always been an excellent way to profit from inflation. If you want to invest in this valuable yellow shiny metal, you can do so directly or indirectly through a mutual fund or exchange-traded funds ETF that owns gold. Number 3. Treasury Inflation-Protected Securities. TIPS, or Treasury Inflation-Protected Securities, are inflation-protected investments. They are bonds whose principal value grows in accordance with consumer prices. They pay interest at a fixed rate twice a year, which is applied to the adjusted amount. Because interest payments are applied to the adjusted amount, they rise with inflation and fall with deflation. Your actual rate of return is the difference between the inflation rate and the nominal interest rate. TIPS are worthwhile investments if the return on investment minus inflation is positive. TIPS are a well-known inflation hedge, but their modest yields may make them less appealing than other alternatives. The solution is that you don't have to choose just one inflation hedge. You can spread out the inflation-protected securities in your portfolio. TIPS are issued for 5, 10, or 30 years. Investors receive either the modified amount or the original amount upon maturity. If you choose to sell TIPS before they mature, you may receive less than what you originally invested. TIPS can yield more than traditional bonds if you diversify your portfolio to account for inflation in an inflationary climate. TIPS can be purchased at the Treasury's website or through your brokerage. According to experts, if interest rates do not rise, it may be an excellent moment to exit TIPS. Number 4. Stocks. When you purchase a stock, you purchase a company's stake. This is why they are also known as shares. Even though stock prices haven't gone up by a few thousand% like crypto, they are much more stable and less risky. The S&P 500 increased by 40% between July 2020 and July 2021. That's an incredible return. When there is too much money in the economy, the value of that business goes up. This means that you are growing at the same rate as inflation. Furthermore, that money is usually spent on essential needs and wants, which means businesses develop faster, so you are not just fighting inflation, but gaining from it. Number 5, debt. Many of you might not like debt very much, but it can be a good thing, especially when there is inflation. Suppose today's dollar is worth more than tomorrow's dollar. That means you have made a profit if you borrow a dollar today and give it back tomorrow. Today, the average price of a house is around $350,000. 20 years ago, it was about $150,000 less than half of what it is now. Because the actual value of the dollar goes down every year, a dollar worth $150,000 20 years ago is now worth $350,000. So when the Fed lowered interest rates and started buying corporate bonds, who started borrowing all that money? The biggest companies worldwide took the initiative, like Amazon, Facebook, Microsoft, and Apple, even though these companies don't need that money. Apple has a pile of cash worth more than $200 billion. But it still borrowed money because why use your own money when you can put it in the S&P 500 and get a return of at least 10% and borrow money at 1%? Even if you invest that borrowed money in your business and get a return of 5% on it, you are still making a 4% profit. On top of that, you get all of these tax breaks when you borrow money, so you will save money on taxes as well. If interest rates are lower than inflation, you should be able to make money on any borrowed money. Number 6, cryptocurrency. Many people who like cryptocurrency think of it as a digital version of the US dollar, which is true in some ways. Although not every coffee shop accepts Bitcoin or Ethereum, cryptocurrency is becoming more popular as a payment mechanism. Several big-name and well-known online stores already accept Bitcoin, and the number of businesses that do so may only grow. If inflation makes a dollar worth less over time, people often look for assets that can grow faster than inflation. Because of cryptocurrency's large swings in a year like 2021, some people believe digital assets can serve that purpose. Many investors already do this with gold, commodities, and other investment asset types. Instead of placing money into traditional and alternative assets to generate and store wealth, an investor may buy cryptocurrencies in the hopes that their value will rise, making them less sensitive to swings in the US dollar. Some investors are already utilizing Bitcoin and other cryptocurrencies to hedge against inflation. This could be a wise decision, but it remains to be seen because it is such a new financial asset class. Its risk is less known and more difficult to compare to other securities. Simply put, the history of cryptocurrency is too short of forecasting its future performance. Number 7, take full advantage of tax efficiencies. If you've been investing or educating yourself about investing, you know the importance of knowing tax laws and associated requirements. Tax efficiency is using all legal channels to pay the least taxes as the law requires. You're tax efficient if you follow a plan that results in you paying fewer taxes than if you took alternative paths to achieve the same goal. Now, maximizing tax efficiency is a popular approach used by wealthy people to protect their money during inflation. You can divide your investment in a way that decreases your tax burden. Remember that taxes might be costly in the long term if you don't invest wisely. On one side, you have investments that don't lose much of their returns to taxes, which go into taxable accounts, and assets whose returns draw significant taxes, which go into tax-advantaged accounts, such as Roth IRAs, retirement accounts. Essentially, you are protecting your investment from high taxes at a time when inflation is also threatening your returns. Number 8, the source for price-secure businesses. The main sign of inflation is that the prices of consumer goods go up. As a result, people's purchasing power is reduced. You eventually start to decrease or eliminate stuff you don't genuinely need. But even when times are difficult, there are some things you must always buy regardless of price. Groceries, petrol, utilities, and so forth are good examples. Even when prices are raised, businesses that provide such items and services rarely suffer. After all, you still had to eat, work, and live. As the value of money began to fall, the wealthy rushed to such firms, investing heavily in them. They secure their money this way and get richer, while the poor become poorer as they pay more for vital products and services. Number 9. Value invest. We've already discussed investing in stocks. However, if you want to invest correctly and adapt to current trends appropriately, you should become familiar with value investing. To understand value investing, you must first learn basic stock concepts. The present market value of a stock may not always reflect the underlying intrinsic value of the company. There are numerous occasions when a stock may be overvalued or undervalued, trading above or below its inherent value. Buying undervalued, cheap companies is what value investing is all about. Stocks that typically lag in market value are likewise less vulnerable to changes in interest rates. As we are seeing today, rising interest rates are how central banks respond to high inflation. Value stocks are also distinguished by lower volatility and more consistent revenue. Number 10. Keep your cash holdings to a minimum. When you think of Elon Musk, Warren Buffett, Mark Zuckerberg, or any other billionaire, do you imagine they can buy anything with a debit card swipe? They could afford most super expensive items if they wanted to buy them, but it wouldn't be as simple as withdrawing cash from their checking account or safe at home. Billionaires, believe it or not, are cash poor. According to reports, the average billionaire only keeps roughly 1% of their fortune in liquid assets such as cash. Most of their wealth is held in the assets and investments discussed in this video. So what happens when inflation soars? Rich people liquidate any cash holdings and invest the proceeds in inflation-protected securities. That's all, folks. One of the most effective methods to prevent inflation is to have a well-diversified and fully invested portfolio. In the long run, money invested in stocks tends to beat inflation, but positions in real estate, commodities, TIPS, or bonds can provide further diversification. Remember that cash on the sidelines will always lose value. In general, inflationary periods, whether temporary or permanent, provide an opportunity to review your financial condition and make adjustments for what lies ahead. What would you add to the list that we still need to cover? Please write your thoughts in the comments section. Remember to like the video and subscribe to The Growth Mindset. See you next time.